Over the weekend, we released our new Smarter MACD scans. For all Volatility Box members, these are included for free with your membership. Simply head over to the Smarter MACD tutorial, and if you scroll down on the right-hand side, you'll see a link that says bonus for the scans link. Click that, and that will take you to the scans area. As long as you're logged in, you'll see the video tutorial here, along with the download link. The video tutorial walks you through some of the tips and tricks in making the scan work inside of the scan tab, working through some of the errors that you would face otherwise. Now let's put the scans to test, and in particular, I'm using the bearish scan in today's example. I ran the bearish scan inside of the S&P 500, and that gave us a list of 69 stocks. Now from those 69, there's one that stands out to me, and that's JP Morgan. I did a little bit deeper dive in JP Morgan, and I'll share why I think JP Morgan has all the right pieces for a bearish setup. Now, since we're talking about the Smarter MACD, let's start the conversation there first. First off, on that daily time frame, if price action with this week's price activity ends the way it currently looks, we'll see that the Smarter MACD has transitioned to red. That's from green to red. What I find is more interesting is if you come into the weekly time frame here, you see a similar transition taking place. So across the board here, we're starting to see little nuggets that, hey, the Smarter MACD is transitioning from green to red. Our first little clue that we should be looking at some bearish activity to come ahead in the future. Now, another thing that stands out is the divergence. If you take a look at this period right here where we had the red MACD, we see this sell-off. Then we have price action make a new all-time high. Here, we don't see the MACD make a new high at all. In fact, it falls about halfway short. Now we're seeing that the MACD is transitioning to red, and this divergence is what I think you can take advantage of with this particular switch to red here. Not only are you getting that switch, but you're getting that switch on the back of a pretty healthy divergence. Now, to help add to this idea, we also have some of our overbought signals. On the daily time frame, we have a total of 4. You have one hiding behind the chart bubble, that's the red arrow, another here, and another with today's candle. These red arrows are the edge signals confirmation, and that's our overbought signal telling us that, hey, we're expecting price to take a little bit of a pause here and revert back to the mean. Now, a simple way that you might use the mean here is the market pulse line on the weekly time frame. The market pulse line is the 10-period variable moving average. It's a nice, easy way, a good substitute for moving averages, figuring out which one to pick. And that line gives us a level of 188.13 for where we would expect price to gravitate towards. Now, I think this is a natural segue to also bring in the idea of our Fibonacci levels. Before we draw extensions, let's first talk about these retracements that we have drawn. This is the COVID high and this is the COVID low. With this extrapolated, we've now hit the 200% extension area. And typically when we hit that level, we see a little bit of a pause back down towards the 1618, which is near $180, 180.77 for the exact level. So we would expect price to, again, gravitate somewhere towards this region. That's what our general bias tells us. Another tool that we can layer on is the Fibonacci extensions tool, and that allows us to compare previous swings to our current swing. So if we take this swing right here and we compare it, that gives us a level near 184.14. We also have this swing right here if we have a slightly deeper pullback, again getting us closer and closer to that 1618 level, which tells us the personality of JP Morgan is such that typically when we do see a sell-off here, we should get somewhere in this zone. So the market pulse is a very safe place to take off initial profits, but really for deeper corrections, you have 180 along with 160 for each of our Fibonacci levels. Now, the last way that I think you could take advantage of this information is by coming into an intraday time frame chart and simply taking advantage of short side setups into our volatility box levels. You'll notice that each time we've breached our long side models, you'll see the level of strength that sellers had here. On the daily time frame, you wouldn't really be able to see that same level of detail, but the 5-minute really allows you to see just how deep this selling activity really was. So we're looking to capitalize on that, and any pullbacks here towards our upper volatility box levels, say we had price gravitate towards the clouds, we're looking at building short side positions into those levels. Again, we already discussed downside levels, but to recap one more time, essentially near that 185 to 180 zone is what we have on the downside. And in terms of stops, or essentially knowing where this idea is cut out, I think you would want to give it slightly above this 205.88 mark, but not too much more. Really, we're looking for this move to get going kind of quickly and for momentum to accelerate in our direction. I hope you found this video helpful in learning how to go from a very simple Smarter MACD scan into analyzing the same chart with Fibonacci and some other tools and picking up on clues that you can use to build trade ideas. Take care, everyone. Good luck trading, and I'll see you in our next update.